Hello, friends, and welcome to my YouTube channel Simply Talks. And today I'm going to talk about Apollo Hospitals. After such a huge run up to around 2300, whether it's a buy or not. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about Apollo Hospitals, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel. It will help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up from now and then. And this watch list is of 70 companies in which I put up buying ranges and selling ranges and what all goes on with those companies. Now about the company. Established in 1983, Apollo Hospitals provide medical and hospital services, one of the marquee hospital brand here in India, and has been here for the last, you can say, 3 to 4 decades. Over 10,000 beds across 70 locations, and they are expanding very rapidly over this period of the pandemic, and 2500 pharmacies across India is available for Apollo Hospitals. The market cap of the company is around 16,000 crores. If you look at the financials, and these are actually Q2 numbers, so these are Q2 FY21 versus Q2 FY20. These are not Q1 numbers, but these are September numbers, and they have come out very decent numbers that they have come out with. 3% drop in sales. The profit dropped by around 15%, but from a major loss making position in the June quarter, they have come out in the September quarter with around 68 crores of profit. There's higher interest cost, and that is a cause for concern, and lower taxes that they have paid. But there is around 30%, 20 to 25% of pledging, and which really pulls me down in quite looking at buying the company. Although the stock has run up a lot, the return on equity is around 7%, not that great. But operating profit margin of 15% is decent enough. If you look at the performance of the company, for the last 4 years, it showed no returns whatsoever till March 2020. So the stock was in a range of 750, 700 to around 1100 to 1200 levels, between that. So 800 to 1200 was the range, but then it has broken out, and broken out sharply, have risen a lot from the Feb March fall, and has more than doubled from those levels, and now at 2300. Fast rise has taken place after foreign institutional investors, high net worth individuals, even domestic investors have bought into the stock, and currently the stock is trading at very hefty valuations. The market cap of the company, as I said, was 16,000 crores at the start of, you can say, March April. Currently it is around 28,000 crores. Stock has doubled from lows of March, that is what I am saying, and more than doubled. And this is the play on the current scenario, current situation that has been plagued, the country has been plagued by the current situation. So this is a direct play, probably that's why the buying is coming in. Although I must say that with the kind of pledging and interest cost that the company has, I would certainly not look at buying it even at these levels. What are my apprehensions, or what are the apprehensions with those investors who have bought into it, or those who are not buying it? Currently the valuations is extremely steep. So if you look at it, the stock is trading at 70-80 times earnings. Even on 1 year forward basis, it is 50 to 60 times earnings, which is exorbitantly expensive, because at one point of time things will normalize, whether it is in 6 months to a year's time, and then probably these companies or these hospitals, etc., may not get the business that they are getting today. It has already run up a lot over the 6 months, so the valuations are extremely hefty. Corporate restructuring will make things complicated. There is a number of corporate restructuring plans that are going on. After that, the business will look even more complicated than it is looking today. And I personally avoid businesses which are more complex in nature, and love simpler businesses. Low promoter holding is also a concern. Now, pledging at 33%, although has come down from over 60% a year ago, I still believe that pledging of around 5-8%, 2-3% is fine, but when you have pledging of shares of around 30 odd percent is slightly deterring for we small retail investors, and that's why I would avoid. Return ratios are low, and I don't compare it with other hospital businesses. I would say that we as retail investors have other opportunities across the board, and their return on equities of many even mid cap companies are very good, and the stock is still trading at reasonable valuations, whereas in the case of Apollo hospitals, things look extremely, you can say, richly valued. So what needs to be done? I would say avoid as an investment at this point of time, especially after the run up that's taking place. Yes, it can be a trading play. What you can do is you can buy at current levels, keep a stop loss at 2100, 2050, or you buy at major declines to 1500 levels with a stop loss at 1200, like that. But look for simpler cash rich businesses which deal in cash. Consumer oriented businesses would be better off and have less than 5% exposure in such stocks. So this was my video on Apollo Hospitals. Please like and subscribe my channel, hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.